Hey, welcome back to Harvesting Income. If you're new to this channel, this is the channel for income investors, and this is about how to make and grow your income. That is what we all talk about in this channel. And today we're going to talk about two interesting funds and doing a comparison of both. One is the XYLG, which is the S&P 500 Covered Call and Growth ETF, and on the other side we have HYLD, which is the Hamilton Enhanced U.S. Covered Call ETF. Uh, Before I get into the video, I would like to just quickly say that this is only for entertainment and discussion purposes, not financial advice. And before I go deeper into the comparison, I'll just go through these funds quickly to give you some idea of how this works. If you've seen my channel, probably you have seen these funds covered in one of our previous videos. But just to give you an idea for people who are new, like this is actually XYLG, which is S&P 500 Covered Call and Growth ETF, and this is from the Global X funds. And this fund is probably wonderful pick for someone who is looking to generate income from covered call writing, and here the fund writes covered calls on 50% of the portfolio. And if you look at the details, like the ticker symbol is XYLG, you can see that on the screen on the right side, and it basically replicates the S&P 500 portfolio. It holds all these S&P 500 stocks and writes calls, that is sells call options on those on those stocks, and not the entire portfolio but 50% of the portfolio. So that's something you need to keep in mind. Like, so they basically, the fund invests in all the S&P 500 stocks, they hold them, and out of that, half of the portfolio is used for covered call writing. The remaining half is just held just like any other index exchange traded fund. So that's how it works. And so it enjoys the advantages of a covered call writing fund plus also the regular index exchange traded fund. So that's the a unique feature of this fund. And so if you look at this fund, it was launched probably September 2020. So that's the brief about this fund. I will go to the next one, give you a brief overview. The other one we are looking at is the Hamilton US Covered Call ETF, which is a contender, and the ticker symbol is HYLD. You can see that this fund basically holds a portfolio of US equity covered call ETFs with overall sector mix similar to S&P 500. Like, sector mix or the stock mix is similar to S&P 500, but keep bear in mind that the fund selects certain stocks and they have their own mix of the portfolio. It's not a replica of the S&P 500, and they provide attractive monthly income, and there's a 25% leverage. um, so these are some of the features of the fund. And when I go down, you can see the NAV is 1323. It's 12 to 13% yield you're getting. And there's a lot of basic information about the fund. The ticker symbol is HYLD, inception February 2022. So this fund is fairly new compared to the XYLG. So let me do a quick comparison here. And I go back to my comparison table. You can see that XYLG was started in September 2020 and HYLD February 2022. So HYLD is about 3 years old. XYLG is now almost like 4.5 years. Uh, when you look at the expense ratio, it's 0.35 in XYLG and little higher for the Hamilton one, HYLD. I will tell you the reason why this is higher. Um, XYLG is basically doing a simple index portfolio, and they are writing calls on the index once a month, whereas HYLD is a little complex portfolio. Let me give you a quick overview here. If you look at HYLD, they own around 10 or 11 underlying stocks, sorry, underlying ETFs within the portfolio. And all these underlying one ETFs are also part of Hamilton ETFs, the same fund company. And you can see that SMAX, which is one of the underlying ETFs, is about 67% of the fund. QMAX is about close to 30% of the fund. And so these two are the major ones, and then you have F max, which is about 9.7%. So if you add up all these, this comes to about, you know 97%, and another, the first three are, the major chunk of the whole fund. You will find that the total weights are more than 100 because there's a 25% leverage. So that's why you have more, you know than 100 when you add up the total. Net assets 800 million, whereas if you look at XYLG, let's look at the net assets just to make a comparison. Yeah, 51.5 million. So you can see that HYLD is much much bigger than the XYLG. And I would also say the reason for that is because there is another previous star ETF in the global X, which is known as XYLD, D as in dividend. So XYLD, you know has a much higher level of popularity compared to the XYLG, which is a growth oriented. So that those are the differences. The fund size is different, whereas XYLG has a longer track record, whereas lower assets. A lot of differences, but I'm focusing more on the strategy and the returns. Let me go back to my comparison. So when you go back here, we look at the strategy. We know that the because of their underlying funds and a lot of management required, because each fund has to be managed, and also each fund under the HYLD is also a covered call ETF. So there is a level of fee involved there, and they write about 30% of the portfolio in the form of covered calls. Like, they don't write the entire portfolio uh, you know into the covered call strategy. So when you look at the comparison, like strategy, XYLG, they buy stocks in the S&P 500 index. It's just a exact replica of the index. Whereas in the HYLD, they have a stock and sector mix similar to S&P 500. So HYLD, Hamilton, chooses certain stocks, or they have a kind of a policy, or they have a method of selecting stocks. uh, they say it's similar to S&P 500, but it's not the exact same. So probably they choose the better stocks or good stocks which work well with their strategy. And the second point is that the XYLG writes calls on 50% of the portfolio, and they write at the money calls. So XYLG is a much simpler strategy. When you look at the HYLD, HYLD writes calls on 30% of the portfolio, and they write at the money covered calls. So the last part is similar. Both of them write calls at the money, meaning the when the call options are written, they are written at the current market level, like not at the higher level or lower level. It's more or less at the current market level. So that way it is similar. But XYLG is writing on half of the portfolio, whereas in HYLD's case, they write only about 30% roughly, and it can vary also. So XYLG has a higher potential of making more dividends because they write more covered calls compared to the HYLD. So that's what we can expect. Uh, and let me go to the next point, the pros and cons. Um, so because of the strategy that uh, we have certain pros or positives. I'll discuss the positives, then we'll compare the returns and compare where they stand. Like, I'm going to show you a chart which compares both, and that is going to be an interesting comparison. And by the way, if you like what you're watching, please drop in your comments or questions or anything you have, and feel free to share with someone who might find it useful, or someone who is interested in investing or income oriented investing. And so let's get into this. Uh, if you're looking at the XYLG, they make moderate premium earnings, and they have a moderate dividend yield because they write up to 50% of the portfolio. So when you look at this one, the HYLD, they have a higher premium earnings, higher dividend yield. But this is actually relative. Both can be, equally good, equally not so good, depending on the market conditions. But both of them can have moderate to higher dividend yield. So uh, I would say that is more or less comparable. But capital appreciation is only on 50% of the portfolio, because 50% is already in covered calls. The upside is capped. So on the other 50%, there is a potential for capital appreciation. Whereas in HYLD, they only do 30% covered calls. So since 30% are going to the covered call side, the remaining 70% has full upside. So that's the key difference here. And both funds have dividends from underlying stocks. So here, if you see in the first 2 points, they are more or less similar. There is a correction here. Both can make moderate or higher premiums or moderate or higher dividend yield. It's not it's not a exact comparison, because XYLG actually is more meant for higher capital growth. They actually give moderate dividend yield, whereas HYLD provides a higher dividend yield when you compare the numbers. I'm going to show you that soon. And the premium earnings can be moderate to high, depends on the situation. And I will show you the comparison of the two funds and then the chart comparing the returns. Let's first go to the XYLG. Okay, so what we see here is okay, let me show you the first distribution rate. It's about 5.74% for XYLG, because it's writing calls on 50% of the portfolio. You get a slightly lower distribution on a monthly basis. I'm not counting any special distributions. This is the regular distribution, which is 5.4% per year. And when I look at HYLD, the same um, thing. If you look at HYLD, you can see that current annualized yield is about 12.87%. Of course, this is what the fund has published. So you must calculate your own dividend yields. Like, if you are not familiar with that, you can watch one of my previous videos, which talks about how to calculate the dividend yield. I have clearly shown you how to calculate a trailing 12 months dividend yield, and how to look at the past 12 months data and do your own calculation. But for practical purposes, right now we will make it simple. We will just use the reference data from the website. So 12.87%. So give or take a few percentage points, the yield is usually in 10 to 13% for HYLD. But whereas for this one, for XYLG, it is usually in the you know 5 to 6% range. Sometimes it can go up to 7%, but mostly it's in the 5 to 6% range. The reason why this is lower is because it also provides a higher capital appreciation. So that is a point you need to keep in mind. And um, and that is also a reason why the fee for this fund is relatively lower. Like, for example, if you look at the fee, um, the expense ratio is 0.35 for XYLG, because it's a simpler strategy. It's easier to execute this strategy, and the costs involved are pretty less. Whereas HYLD, Hamilton Fund, has a higher management fee. Even though it says zero, the underlying fees of the underlying ETFs is around 0.65%. And that's what I mentioned in my comparison. Uh, Now let's look at the return comparison. Like, when I compare these two funds and see the returns, I already set it up for you. So if I look at the comparison on this dividendchannel.com, uh, I can compare HYLD with XYLG. So it basically takes the February 2022, which is when HYLD was started. The newer fund started around February 2022, which is the HYLD. And from that point, both funds are being compared. So comparison is up to March 25. So based on this, what we can see is we have two charts here. Like, I'm going to just look at the one without dividends reinvested. So this is assuming that you don't reinvest your dividends. You just invest and look to get the dividends as well as the capital appreciation. So HYLD has delivered about 10.2% total returns. This is in the last 3 years since the fund was launched. And XYLG, on the other hand, made 21.36%. So you can see a clear difference, like 11% difference almost like this is the total returns. Total returns would mean price appreciation plus also the you know dividend yields. So capital appreciation plus dividend yields. So in both cases you can see that the price has gone down compared to the starting price. From 30, XYLG fell down to 27 something, and HYLD from 16 to 13. I mean, both of them fell by about $3. But when you look at $3 on a $30, it's roughly like a 10% fall. Whereas if you look at the $3 fall on a $16 dollar fund, it's almost like a 18-20% fall. So that's the reason you see the total returns lower in case of HYLD, despite the fact that HYLD makes 12% plus yield on a yearly basis. Anyway, this is a comparison for 3 years. In future, this could change, but overall, when I look at the performance over the last 3 years, I can see that XYLG is clearly outperforming the HYLD. Like you can see the blue line, which is XYLG, and black line, which is HYLD. It's clearly shows a kind of deviation. In the initial months, they were almost on par. Like probably around 2023 onwards, the performance has actually deviated. Basically, HYLD is providing lower amount of returns, whereas XYLG is actually performing better. So $10,000 in XYLG would have given you 12,134, whereas with the Hamilton Fund, you would be sitting on $11,020. So there's a $1,000 difference on the 3 year basis. Yeah, that's a clear difference between these two funds. I mean, this is not an indication that HYLD is a bad fund or you should not invest in it. It has still given you a total returns of 10% every year, despite all these fluctuating market conditions. So that is something to consider. Let me change the dates and see how this would change if I were to look at different time period. So let me put January 1, 2024, and see where they stand. Yeah, let me look at the second chart. So if you look at the last 1 year, 3 months, you can see that XYLG is actually underperforming. So this is pretty interesting because in the last 1 year plus period, XYLG is underperforming, whereas Hamilton Fund is making 23%. XYLG is close to 19.5%. Clear difference here. Similarly, in the dividend reinvestment scenario, it is different. So you can clearly see that in the last, when I change the time period, the performance actually varies. In the initial time, more or less they were similar, but in the as we go into the middle of 2024, Hamilton funds are trying to outperform. Probably in some cases it's very close, but generally when the markets, I think in 2024 markets were going up, it was pretty bullish. So Hamilton funds were doing pretty well. But recently it's again, the gap is not much. Like there is a difference. Hamilton is definitely outperforming the global X. So pretty interesting. Like if you change the time period, you will get a different kind of result. um, whatever I'm saying, it's as of today, this is what the performance is. So it's not going to be the same forever. Like, so that is something to keep in mind. So with that backdrop, like you have seen two different scenarios, right? So you've seen last 3 years, global X was the winner. But if you look at the recent time, like last 1.5 years, Hamilton seems to be outperforming. So it's a kind of a different strategy or different ways they are playing the market, and depending on the conditions, each fund will have a winning window. Sometimes this fund wins, sometimes that fund wins. So that's always going to be there. Nobody can guess who is going to be the topmost. But at the end of the day, you want to make double digit returns, beat inflation, and create wealth for yourself. So with respect to cons, it's pretty similar for both of them. Both of them can have upside capped. So XYLG can have upside capped because of the because of the call writing. 50% of the portfolio will have that ceiling because of the call writing. And with HYLD, only 30% of this portfolio has that ceiling. So HYLD has a much higher potential for appreciation if the markets were to rally, in a big way. Uh, but XYLG cannot be that far behind because they are also having 50% upside open. And when there is a 50% upside open, and they can benefit 50% of the capital appreciation of the whole market and still benefit from that. And each one is playing in a different strokes or different types of strategies. And there's a possibility of NAV decline in XYLG because 50% of the portfolio is already covered by the call writing. Whereas in HYLD, it is going to be a little moderate. In case of XYLG, it was minor, but in case of HYLD, it can be a moderate decline. And this is again depending on how it plays out, because we don't know exactly if only the specific stocks chosen by HYLD are going to have a crash or the entire market is going to fall. We don't know. If the entire market is falling, obviously XYLG is going to have an impact. And Hamilton funds can benefit if they choose certain stocks or blue chips which are able to weather the market conditions. But again, if the choice of stocks go wrong, then things can go wrong as well. So there's always a pros and cons of each fund, because stock selection can also be a positive. Sometimes it can be a drawback. It depends on the performance of the fund manager or the method or the approach used by the fund in selecting stocks and how they execute those strategies. It all depends on that. So overall, what I feel is that both funds are equally good. It depends on what you want to achieve. Uh, Before I end this video, I just want to tell you quickly that this is not a apple to apple comparison. First of all, because I've tried to compare this just to give you the flavor of both the funds. And this table is only about strategy and a few comparisons. There is a lot of differences between these funds, which we can cover in a big video. But for this video, I would say that XYLG is more suitable for people who are looking for a pure index fund with a covered call strategy. So index covered call income, if that is what you're looking for, then XYLG or Global X fund is a good option. And given that they write calls on only 50% of the portfolio, you're not giving up all the upside. You're still benefiting from, you know, the premium income, plus also you're benefiting from capital appreciation. So you get a mix of both. So that's the reason why they are still making double digit returns. And HYLD, the Hamilton US Covered Call ETF, uh, that is perfect for someone who is looking for a basket fund, which basically means like it's an all-in-one basket fund. How do I put it? Like it's basically like a kind of a balanced fund which has a mix of everything. Like for example, if you go to a restaurant or if you go to any fast food place, you get a combo meal or a combo option where you get a mix of everything. A mix of the main dish, side dishes, some snacks or fries, plus you also have drinks or other accessories and other food, which is part of the whole combination or a combo. So same way, HYLD is like a combo which it has multiple funds here. I will just quickly take you through that. HYLD, you can see that they have SMAX, which is the US yield maximizer, which covers like S&P 500 stocks and a select stocks from that. And they have Nasdaq stocks, tech stocks, and not exactly the Nasdaq, but a selection of those stocks. And US financials. Then they have healthcare. Then they have 4% in gold, and you also have energy. Then you have REITs, and the last two are basically US Treasury bills and US bonds. So you have a mix of different asset classes packaged into this fund. So that's why the HYLD is not a regular covered, just a regular covered call ETF, but it also packages multiple assets covered call ETF into one. So they have a gold covered call ETF, they have a US Treasury covered call ETF, and so on and so forth, like Nasdaq, S&P. So you basically investing in everything, like It's a kind of a balanced covered call ETF fund. So that's the advantage of investing in HYLD. So you can also invest in the global X fund XYLG, and probably look at other funds and diversify. That's one option. Or you can buy a basket one like HYLD and then diversify into other asset classes. So all the options are available for you. So both have their own pros and cons. And before I sign up, I would say that if you are starting off, you can pick either fund, or you can look at other comparable funds in the market and then see what suits you, and then you can make a final decision on that. And if you want more information, more details, I'm always happy to help. Please feel free to drop your comments or questions below. And feel free to subscribe to this harvesting income channel, which is the only independent channel for income investors. Thank you and have a great day.